Welcome back to the channel. I'm Crypto Trend Trader, and today we're going to be taking a look at Bitcoin and the imminent breakout. But before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please trade at your own risk. Don't risk more than you're willing to lose. Alright, so here we have Bitcoin on the daily, and we're looking at the Bitfinex chart right now. And what I have here is just a couple moving averages on the chart. We have the 10 in red, 21, 50, 90, well 89, 200, 200 simple. And what we're going to be taking a look at basically is where we've been finding support and resistance, and then also the pattern that's been developing. Now I'm seeing again all over the place people are talking about this is not a descending triangle, it's a symmetrical triangle. That's not correct. This is in fact the descending triangle. It was a symmetrical triangle. You could argue at one point in time, if you were going from wick to wick, you could argue that it was in fact a symmetrical triangle. Okay, but once we broke down from this point right here, or anyone that knows what's going on ahead of time, once we broke down from this point right here, we confirmed that we were in fact finding support here on the fib level. Okay, and that was creating our baseline. Now if you want to go by the wicks, that's fine, but this is how I know that I'm right, and this is indisputable fact right here, that this was in fact the descending triangle the whole time. If anything, the pattern hasn't developed yet, and we're in fact going to put a downsloping channel once we break through this to the downside. But right now, as far as it's concerned, as soon as we broke through the bottom of this quote-unquote symmetrical triangle, if all these people doing technical analysis calling this a symmetrical triangle were correct, we would have gotten a break with massive amount of volume as soon as that breaks, and then we would have gotten follow through to the downside. We did not get that. There's been almost no volume since the break, and that's what you're looking for confirmation, is volume. Because if you see a move happen and there's no volume behind it, it's not a real move. I mean, it could just be anybody front running the market, just little guys, little guppies swimming around buying through a resistance, buying through a support, selling through a support, whatever it is. This is not a symmetrical triangle. It never was a symmetrical triangle, and it's never going to be a symmetrical triangle. Now if you want to argue this is a channel, that's perfectly fine. We can argue it's a channel. I totally agree with that. We're getting consistent touches on the bottom of the channel, consistent touches on the top of the channel, consistent reactions off of the heart line on different time frames. That's what's developing. Okay, that's the correct pattern that's developing right now. Okay, in my opinion. But as of now, until we get, and that's fine, that's extremely bullish. If we get a downsloping consolidation, even if we bounce up here and come down, or if we just break and then find support on the 200 moving averages and bounce around inside the channel, that's perfectly fine. That's completely fine. That's extremely bullish. It's a reaccumulation pattern, and it's essentially saying people are loading up their bags, and then when the price is right, it's not going to sell off anymore. We'll break to the upside. That's a great consolidation pattern if you're bullish. Okay. This is extremely bearish, all right, and we're going to know that because what's going to happen is we're either going to break out the bottom here with massive amount of volume, and we're going to form that descending channel that we were just talking about, or right now what it looks like is going to happen is it looks like we're finding support again here at the triple bottom baseline. That's our triple bottom forming right here. This is not, we did not break out of a symmetrical triangle. If we did, we would be selling off very violently to the downside, okay, and it would have already happened. Right now what's happening is we broke through this support line. We broke through the moving average, 89, and after we broke the 89, after finding support 1, 2, 3, 4, 5, 6 times, we finally broke through it. We did not get a massive sell-off. In fact, we got a bounce off of the triple bottom. We got a retest of the 89, and now one of two things is going to happen. We're going to defend the 1089 cross right here, and we're going to move back to the upside and possibly put these moving averages back in order, move all the way to the top of the triangle, potentially even get a spring outside of the top of the triangle, and then a massive sell-off, a dump, and that's essentially faking a breakout. Because as soon as we get, realistically, you see, as soon as we took out this high right here, we got to jump right up immediately. We've been calling for this retest since way back when. We were calling for the break and the retest a while ago. So you can look back at my videos and see this is all played out exactly right. When everybody else was still talking about the symmetrical triangle, we already had it drawn out like this. So But regardless, that's fine. You can go back and see if I'm right or not. But the fact of the matter is what's happening right now is we're coming back for that retest. If we move back to the top, we can continue to fill out this pattern because we're way too. Patterns like this large of a pattern after this large of a move, they don't just break. They don't just all of a sudden break. They tend to fill out and take time and consolidate. One of two things is going to happen, either distribution or accumulation. There's either people unloading massive amounts of coins or there's people buying up massive amounts of coins. But that does not happen, overnight. What happens is these patterns typically take about 75% of the way through, 75% of the way through before they break out. So you'll see more realistically, we're looking at a breakout somewhere in like the end of October, towards the end of October, third week of October, somewhere around there is when we would expect a breakout of this pattern. What's more likely to happen at this point in time is we found a support right here. We're going to break through here. We're going to do a pump up to the top of the triangle and at least retest the top of the range. And then we can more realistically calm down, possibly break out the bottom, get the retest. And then once we get the retest, then we can sell off to lower prices, hit our measured move, hit these moving averages, and then we can see where that goes from there. But right now, the way this is working is if this comes up here and gets rejected, then we could come back down and we could see the sell-off right now and retest. And then that's going to create, like I said, that's going to create our parallel channel like we were talking about. Because what that's going to do is basically a sell-off right here will bring us down there and then bring us back down, and we'd most likely find support on one or both of the 200 moving averages. And again, that would look like a break out of the symmetrical triangle or the downsloping triangle, however you want to call it, but that would be a confirmed breakout that we would likely see a nice amount of volume come in, and then people would be thinking, oh, we're going way lower, we're going way lower, and then obviously as we touch this bottom, come back up, test the hard line, and we can consolidate back around inside this pattern, people would then be realizing, oh man, it was a channel the whole time. If only we would have known. And that's why it's important to do TA and to see what's developing before it develops rather than doing hindsight technical analysis. Because anyone can look back at an old chart and tell you, oh, this is what happened, that's why it happened, da 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 da. Technical analysis is designed so you can anticipate future moves and trade with an edge based on what's going to happen or likely to happen in the market. And that's the type of technical analysis I do. So there you have it. That's basically what we're expecting to happen here. We got the break of the 89. We're getting the retest right now. So far it looks okay. We've not been able to break above it, but it's still early. The fact that we didn't get a strong rejection off of it though, and that we're just consolidating right now, leads me to believe that there is a possibility we could continue to consolidate here and then break to the upside and again fill out this triangle. But if we hang out here too long, we could just get a sell-off and take us back down. We do want to see some kind of volume come in and some kind of buying pressure come in. But, it takes time. The market's not that confident that we're going up from this point. I think this is actually a very good entry point for a bounce. It's very easy to play a situation like this because your risk-reward is easily definable off of this support line. This triple support line that we've gotten based on candle closes, not wicks, based on candle close validation. So essentially what you could do right here is you could say, okay, I'm going to take a position if we break above this right here, and I'm going to take a position up to the top of the triangle, and if we break down out of the triangle, then we know, okay, this is invalidated. So you could essentially place your stop loss like down here. I personally don't like placing my stop losses just below previous candle wicks because that's what stop hunts literally do. So oftentimes, I had discussed this actually in a previous video. I'm going to give away one of my secrets. What I will do is I'll enter a portion of a position at the risk reward like point that I'm showing right here. Okay, as soon as we broke above this and close, or even if you just want to go by the break, if it looks solid, there's volume coming in, it doesn't look like it's just going to sell off back to nothing, that's fine, you could take that move. But what I will do is, instead of just placing my stop loss right here, what I'll do is I'll run my stop loss a little longer, which that's crazy. 10% stop loss on a 15% trade. That's not good. I mean, that's 1.5 times ratio. But then what I'll do is I'll set a second trade where most people will initially place their stop loss at. And you'll find that what people do is they look at that previous wick right there, and then they'll place their stop loss just below that wick. So if we start to sell off and we come down and we take out the low of that, they say, okay, my trade's invalidated, I was wrong, so now we're going to sell off and go to the downside. But in all actuality, what ends up happening is it's a stop hunt, comes down, wrecks everyone's stop losses, never closes, and then uses that fuel to skyrocket back up to the upside. It's the same spring that we see here when we break through and we get a false breakout to the upside. It's the exact same thing. We would get a fake breakdown right here, take out everyone's stop losses, look like we're about to dump, and then it gets bought straight back up just like this, and it ends up with a big wick and a tiny little body on the candle, and then we get massive amount of continuation. And to tell you the truth right now, that's what I'm expecting to happen. So what we're going to go ahead and do is, like I said, we're going to place a second trade right here. And that's going to be the entry point, is going to be where most people would be getting stopped out at. So if price continues down here, it will actually enter this position, and then we could take a more realistic stop loss right around here. So essentially what happens is we have, if you take your trade up and say you're going to use 10% of your capital on this trade, okay, what we're going to do is we're going to enter 5% here and 5% here, or we'll enter 3% here and 7% here, or 4 and 6, something like that essentially. So that what happens is, say you're entering a $1,000 position, let's call it 100 just because it's easy to do math. So let's say you're doing a $100 position and you have $1,000 in your account. So what you want to do is you want to start with like 30 or 50 on this position of that 100, and then you want to put the remainder on this position. So what happens is, if this position gets entered, if you take this trade right here and then it sells off and you're wrong, rather than hitting your stop loss and taking you out of the trade at a 9.5% loss or 6% loss right here, what you're going to do is, once this trade gets triggered, it's going to average this out. So if the price does come down and it takes out your whole entire trade, you're going to basically have, let's say you put $33 here and $66 here. When it sells off, the $66 is going to be at a 4.37% loss, and the $33 is going to be at a 9.48% loss. So what it's really going to amount to is about a 6% stop loss, which is, it's not a crazy stop loss or anything. So if you average out to about a 6% stop loss, it's not bad if you do get taken out of the trade, because realistically on the upside, you're going to do way better than that, because you're looking at 22% off that and 15% off that. So a 6% loss, if you end up in a 20% trade, that's a 3-to-1 risk ratio. So that's one way that you can manage your capital, manage your trades, and you can still, instead of getting taken out of a position, you can still take your normal position, and then you can have that backup position. And then if you do get taken out of the trade, that's perfectly fine, but you're not going to get taken out on these little fake out stop hunts. And you'll see this happen in crypto more often than not. Stop hunts, or people buy the breakout and the breakout gets faded, and then next thing you know, they get wrecked. So that's one of my secret little, personal development, whatever, entries for a trade. I like to use that. It's very effective. Feel free to check it out. You can experiment with it. Or next time you're about to take a trade, just place this here. You don't even have to place your trade in, and just see what happens. See if you get taken out of that stop loss when you place it right here. And then see if you get taken out of that trade, and then see does the trade end up going in your direction again. Because more often than not, there's only two directions a trade can go in, up or down. So a lot of times what happens is they'll figure out how they're going to take people out to the downside and then move it up, or they figure out how they're going to take people out to the upside and then move it down. And what that is, it's rocket fuel. Once you take out that low and everybody's stop losses are getting hit on a short, they put in a short as soon as we break down here, and then, oh man, stop loss getting hit because my price is moving higher. So now that's rocket fuel. What happens is the short position gets closed out with the stop loss, and then they market buy, and what that does is it starts to force the price up, 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 and then the price continues to go up, and that's the fuel that you use for these big moves, because it's much more difficult to just consolidate in an area and then get a strong bounce off of it. So that's just a little bit on the basically on Bitcoin technical analysis, a little bit of the trading strategy as well. We know the Bitcoin breakout is imminent, but honestly, to tell you the truth, I don't think it's coming anytime soon. We have a very, very large pattern, okay? If this ends up being a triangle, again, we're looking at mid to the end of October. If this ends up being a channel, however, if we do hit this This is what I think is going to happen. If we do hit this 90 right here, this 89, and then we sell back off, what's going to happen is we're going to go down here and then we're going to create that channel.